Hello traders, my weekend video. I am all short the market. I don't have one long position. Um, I was going into the banking earnings next week under the thesis that if this market, if anything is going to drive this market lower, it's going to be the banks, and we've got solid banks all next week. And in my opinion, the banks are the most bearish segment of the markets. Period, hands down. And if they don't sell off, then the markets are going to go much higher. But to justify the really elevated skew on the put side, and I'm still a strong believer that this is a bear market rally in this market. So that being said, that's what I've done. I'm short, so net short. I don't have huge, but I am net short. Basically, what I did with my Fibonacci retracement, I measured the distance between the 125 SMA and the 50 SMA on the weekly chart, and then let it transfer over on the daily chart here. And what we've seen on the S&Ps, we have managed to rally up uh, just slightly in between above the 50-day moving average, but still under the 125-day moving average on the weekly chart. So this is still a very bearish chart pattern situation in the S&Ps. And then our stochastics is telling us we are already in an extremely overbought situation, and we got a little bit of a curve there at the close or yesterday or Friday because we couldn't push out higher. So that's why I started initiating puts going into the earnings this week. And so far, the futures are justifying my move. If you know, and the Nasdaq's really selling off in the after hours or in the pre-market session over in Asia right now. And we got the same little hook going on here, overbought situation on the Qs. As you can see here, the 50-day moving average was much lower on the weekly, and then this is your 125 SMA way up here, and we've come a considerably higher on the weekly Qs on the spread between those moving averages. But we're right here, right above that 50% move between the two moving averages. So that's why, and finding resistance right here at the 50-day moving average on the daily. Okay, and that's another reason why I went short the Qs into this week. And I do have some short techs in this situation, knowing that this is typically would typically be we've gotten half the distance already, and so I think this is a short area. And then the IWM is the worst of them all because it's had to come off of such a low. And if you look at this on your weekly, your 50-day moving average is way up here at 149.19 on the weekly. We haven't even got back up in between in our moving averages yet. All we've had is a responsive short covering rally on the daily time frames because of the oversold situation, and we're just now testing the 50-day moving average. And we do have the rollover, and it's actually rolling over even after Friday. It's even got a stronger signal that we might be putting in a topping formation on that. So keep that in mind. I think going into this week, IWM by far has significant risk, more risk than the other indices, in my opinion. The reason it came down was because of the financials and the oil sector and stuff. But still a lot of risk for the financials and the IWM, in my opinion. So you got to keep an eye. I think IBB is overbought too, and that was one of the primary driving forces to the upside. The biotechs were catching an amazing short squeeze, and I do think that trade is come to an end. We've already hit 100% move. We've already back to the 125 weekly SMA on our biotech. So that is a strong responsive short point. biotechs, in my opinion, going into this week. But we don't have the hook yet to confirm that scenario. I do think the biotechs are really going to come in this week, and probably we're going to have come right back down to this channel, the 103.30, 103.40 area, sometime this week if we get some selling pressure in the markets. And then the diamonds. And the diamonds, same deal. We've gotten back about 50% of the move between the 50-week moving average and the 125-week moving average. And on the diamonds here, we are still below our daily 50 SMA. We haven't even come up and tested that yet. So the diamonds, because of Boeing last week, were really, really strong. And we do not have any type of reason to think the diamonds are coming down unless the market starts showing relative weakness, which the futures right now are showing significant relative weakness. Look at this. We are right now on the diamonds pushing out below Friday's lows. So we've actually have a print below Friday's lows right here, right now. So, and we haven't even, this is just in the overnight session. We haven't even seen Citigroup's earnings tomorrow yet. So I do think they are selling to the news up here in lieu of the extreme risk coming into Monday's session. Because keep in mind, Tuesday they have the Brexit vote on top of everything else. So all kinds of reasons to sell this market ahead of the news come Tuesday, in my opinion. So we'll see what the reaction is to Citigroup's earnings, but I do not think they're going to be very positive at all. And if you look at your ES, it's down 20 points. We've already cracked Friday's lows, blew right through Friday's lows already on the ES futures. The worst of the bunch is the NASDAQ, 61 or almost 62 points down. Completely obliterated Friday's trading range. And we saw in our Bollinger Bands that there was a nice little squeeze, and we were pushing. We couldn't push out to the upside there Friday. That was a major tell that we were at the expected measure move for the week, and we could not push out above that. I mean, there at the close Friday, we pushed out just a little bit right back here. Okay, but we are getting total rejection in the so far in the early trading hours here on Sunday. Not a very good sign, and we're right down here. We're testing Thursday's lows right here right now. So we'll see what happens. Getting a little bit of responsive buying right now, so we'll see what happens on that. And then that's the worst one. I don't need to see. I don't really have the Russell futures on my charts. So just keep this in mind. All kinds of risk from the banks this week. Serious risk. So if you don't have to be long, you shouldn't be, in my opinion. So, okay. Okay, some things that I wanted to get a little comparisons. Well, the weekend going into last earnings season, I compared that to what we're at right here, right now. And with the exception of Netflix, I looked at it on earnings day and compared it to that. And basically, what I'm seeing right here, we left Friday with the massive sell-off in the VIX futures. And basically, what we've got right now is a situation where the expected moves from the VIX was on the major indices was smaller than what we had way back October 7th, the weekend, October 7th, before the launch of last earnings season. So basically, this told me to start getting short the markets going into earnings season whenever they're actually predicting a smaller than expected move. This earnings season versus last earnings season, I say that didn't make one bit of sense to me at all. Whenever the VIX back then was only 1527, and the VIX right now is 1819, and we're predicting a smaller move, this did not make one bit of sense at all to me why they sold off the VIX futures Friday. It was a anomaly that for short traders to start loading up Friday to take advantage and most people like to wait until after the first earnings come out. Well, the opportunity was Friday to start loaning to the short side, and so far in the pre-market sessions, it looks like I did the right thing. So we'll see what happens. And also, but most things, because the IV's higher, most earnings this week, they've already priced in a larger than expected move versus last, you know, and some of them are just about the same, but the diamonds are actually pricing in a little bit higher, slightly higher than uh, right before earnings week last time, but not very much more than last time. But the banks, man, look at this banks. The expected move increases. They went from 30%. We're up in the 53% implied volatility now on Citigroup coming into tomorrow. So, yeah, they are really, and these are going to expand. Citigroup expanded the most because tomorrow is the earnings date. Well, Wells Fargo, Bank of America, they're the next day. These are going to expand going in to the close tomorrow. And if Citigroup does decide to sell off, they're really going to expand tomorrow. So over here, these are really going to expand versus 10 the weekend of 10/7 of 2018. So I just wanted to point that out. You've almost got double the implied volatility in Goldman Sachs going into earnings this quarter, almost double already. And we got 3 days for them to even jack that even higher. And look at this. We're more than double on Alcoa. And let's see, is there any others here that really? Morgan Stanley's double the implied volatility, more than double the implied volatility on American Express. So they are pricing in a lot of risk, and there is no sense in having a VIX this low whenever they're expecting an expansion in range going into earnings this week. That didn't make one bit of sense to me at all. So just keep this in mind, and then also look how the historical volatilities. I started here. I didn't finish, didn't I? Sorry about that. But the historical volatilities were really low going into October. We were coming in with extreme rock bottom historical volatilities in the indices, and they've jacked east way up to highs on the historical volatilities. We're coming in with very high historical volatilities, and these are a longer based analysis of VIX. And these, when they get elevated, they stay elevated a lot longer. Okay, so I just wanted to point that out. Our historical volatilities, most of them are double, if not triple. Like look at this on the IWM. Our historical volatility is triple what it was back in October. Okay, and we're looking what is that? Eightfold, an eightfold increase of implied volatility versus October, and this VIX is not reflecting this major increase in implied volatility for the SPY, in my opinion. And you do not want to be options premium seller on the S&Ps seeing this scenario at all. Period. End of story. Going into the weekend, I did put on a starter position in Chipotle Grill, swing short. We'll see what happens here. We actually got the touch on the stochastics and an extremely overbought situation on our Chipotle Grill. And the valuations right here, right now, on Chipotle, you're 45 times Ford's expected earnings for a restaurant. This is an extremely high valuation for a restaurant chain, and that is one of the main reasons I took Chipotle Grill. If the markets were to start, if this is truly a bear flag, Chipotle Grill is really going to take a haircut here soon. Very easily coming back down to the 464.82 area, in my opinion. Very, very easily for a move like that could happen if the markets were to have some sort of sell-off here. And then Netflix, didn't point that out. I can't remember if I pointed it out or not. Netflix. Now, this is the one exception. I looked back at Netflix, what it was trading right before earnings came out. Okay. And it was trading for a $34.88 move going into right before earnings. Okay. And we still have a couple days. So, you know, this expected move could pop up. But right here, right now, the expected move is smaller than what we got last time. And we had a really big gap up, and then it came down hard. So and the news that came out was horrible last quarter, and everybody seems to think they're going to change this quarter, and I'm not in that camp. I think it's a little unrealistic, the expectations. I just wanted to point that out, that the expected it's they're not pricing in a bigger move this time on Netflix than they did last time. The IVs are high though. I will not deny that. The implied volatilities are extremely high here. Okay, Netflix, Square. Because we were doing financials, I did put a short position on for Square here. The implied volatility wasn't too bad, so I went ahead and we had this hook situation going on the stochastics, and I thought this was a very smart area to start to the short side if betting on a weakness in the banks this week. So this is another trade I got on. And then I also have, let's see here, Netflix, Square. Let me stop this for a second. And then also, I was actually getting a hooking pattern right here earlier in the day in Starbucks. We were getting a hooking pattern, and wouldn't you know it, at the end of the day, Friday, it was the first one I bought. They rallied the heck out of Starbucks. I thought we were getting a rolling over situation. We had a downgrade in Starbucks based off of China information. And if you notice, we have a trend here, trend line. I thought we were going to be coming down and retesting the trend line based off of that news. And with the stochastics giving me a signal. And so, yeah, so I'm underwater right now on Starbucks. I thought we were going to get a retest of the trend line, if not break, based off the news. So we'll see what happens. If the markets are weak, I might be A-OK on Starbucks. So those are some of the trades I got on. Some trades I'm really looking at. PPG reports later this week. This company here, I mean, total panic in the markets once they reported. This is one of the major events last quarter that sent the markets rocketing to the downside. They're reporting the end of this week. So right here we have a responsive topping formation in PPG, and I have this on my. I want to start entering this tomorrow to the short side, in my opinion, on PPG, thinking it's going to find lower lows this quarter, because they had absolutely horrible guidance based off of China a forecast. Okay, what I really want to talk about here is the dollar. We have our stochastics is telling us the dollar is ready to take a rally. Okay, and I want to point this out here. That is the prevailing thesis, that we are going to give responsive bid into the dollar after quite likely this week. And the reason for that thesis, Tuesday, is in England. They're having the Brexit vote finally. And here's the situation. The media and all the politicians are saying there that the vote is probably not going to pass. That's what they're telling us, the headline risk. Okay. And they had a no confidence vote for May, Theresa May. And she has been, there have been reports out there, she's been preparing herself to, resign her position a couple weeks ago. That was the news that hit the wire. So right now, the prevailing theory is the Brexit vote is going to fail Tuesday. And the failure of the Brexit vote is going to mean that there is going to be no Brexit deal come March. Because once Theresa May leaves, they won't have enough time to come up with a deal at this point. So one of the major theses that I went in Friday, I started adding to shorts. They were going into this Brexit thing coming Tuesday, and I felt like it was going to put significant pressure on the indices at these extreme high levels, and people wanting to go to safety going into the Brexit vote Tuesday, and so basically, there's two scenarios going to happen here come Tuesday. You're going to see a massive, we're going to see a substantial rally in the dollar, which is likely going to be negative for crude oil and stuff and commodities, or we're going to have an outright breakdown in this high distribution in the dollar if they do some wild thing and manage to pass that Brexit or have some sort of plan to leave the euro come March, then we're going to have a collapse in the dollar, and that's going to be very bullish for commodities and quite frankly bullish for the markets, in my opinion. So it's sad to think that such a global event could have such a major impact on our markets, but it does, in my opinion, and lots and lots of risk that the Brexit, all based on a singular vote come Tuesday. So just keep that in mind, the situation we're in here and how that's going to affect your positions this week. Okay, this is what I wanted to point out. This is another reason I started initiating Netflix. The stochastics, one of the highest reads we've had on stochastics on our internet ETF. We got the touch Friday. I mean, it wasn't just rolling over. It actually touched. So that told me that we were going to have some responsive selling going into this week into the FANG names. And I didn't want to wait until Monday hit and the numbers came out to start shorting the FANG names. And we've already hit the 78.6% of the range between the 50 SMA and 125 SMA on the weekly. Okay, so we are even more overbought on the FANG names than we are anywhere else on the NASDAQ. And here we have a responsive sell signal off of a parabolic move up. So that was just a no-brainer to me to start initiating short positions, seeing that we have a responsive sell signal in the FANG names. Okay, so I'm going to continue adding shorts tomorrow, and I am not touching calls. I could be dead wrong, of course, but I do think there's going to be substantial risk in the banking sector this week, and maybe next week, once we get a little pullback this week, maybe we get a continuation to the upside next week. As far as I'm concerned, this week, no continuation. And I want to show you one last chart. Okay, I hate to take a chart from another trader, but he has such a great analysis here, and I'm putting it in my own words, what he's having to say. But basically, we have reduced about, we barely started any reduction at all in the Fed balance sheet. Okay, and look what's already happened to the markets. It's just complete and total turmoil. And basically, the Fed has already announced they intend on reducing the balance sheet by 2 to 2.5 trillion US dollars. Trillion US dollars. Now, guys, you know, the chairman of Fed, Powell, he came in, he said he was going to be more responsive to the markets, and stuff. But the bottom line is, they know that this balance sheet has to come down to be prepared for any type of further recessionary pressures, okay, or depressions. And he knows all this Obama era debt, and that's what this is, Obama era debt. This has to be reduced. So even though he told us that he's going to be more responsive to the markets, bottom line is I wouldn't buy it one bit, because they've barely started, and this is going to get really bad. And the S&P is down to 2,000. We just don't know how soon it's going to happen. And I would say by March we're going to see 2,000 on the S&P 500s. That's just my honest to God belief that we're going to see a substantial, rapid decrease because of the need to reduce this Federal Reserve balance sheet. Them putting all of this debt back into the public market. And guess what's going to happen whenever they continue to put this debt in the public market? It's likely to start raising yields. That's right. Well, we'll see. We'll see what happens. It's likely it's supply and demand. If they're putting this much debt into the public market, yields are likely to go higher. Demand for higher yields because of all the hitting the markets. And this is and also the federal government is going to need more money this year. They're going to have to issue more treasuries just to keep the lights on for the government than any other time in government history. And that's part of the whole tax reform policy. Now they're going to have to borrow government debt just to keep the lights on for the government. So that's an unfortunate thing. We not only have the balance sheet coming down, now we're going to need all kinds of extra money. All of it's going to be inflationary and drive up long-term, drive up yields. People are going to demand higher yields. All of this hitting the markets, and that's not even talking about the private side. We have $1 trillion worth of U.S. corporate bonds maturing this year. Okay, on top of all this other stuff. Okay, so we are in the midst of a debt crisis. That we are on the very stages of a debt crisis. Okay, and too many investors are paying attention to just how serious of a situation we are facing here going into the new year, and they just seem to think this is a one-off situation. We're going to just continue higher, higher, higher. And bottom line is, I would say with 99.9% certainty, the highs are in the market, and we are going to find whenever we do have good earnings, what we're going to see is the market, the stocks are going to rally and fail. And what's going to happen? We're going to have the stocks that disappoint are going to really be punished far outside the expected moves, and the ones that go up are going to go up either at or less than at the expected moves and underperform the markets. So you really don't want to be pushing to the long side in this situation with out of the money calls or anything like that. Betting on a big upside move, even knowing that we're going to have fairly decent earnings numbers coming out this quarter. Okay, that's my bias on the thing, and it all has to do with this massive debt overhang that's all coming mature this year, and it's going to continue to put long pressure on these markets. Okay, that's all I got to say for my weekend video, and I will see you tomorrow. Anybody got some put ideas or short ideas, really good setups, please post them at the bottom of my video. If you like it, I am here to learn. If you got some trades, please post them on below, and look at them, and I will get back with you, and I actually might put them on. So we're all here to make money. Good luck.